A financial crisis occurs when there is a decline in the nominal value of a nation's assets, where assets are resources with positive economic value. Financial crises are often associated with the formation and subsequent bursting of an economic bubble. Aside from collapsing asset prices, there are dramatic declines in production of output, employment, currency values, consumer and business confidence, and rises in debt and bankruptcies. This combination of events causes countries to plunge deep into recession, defined as when there is a general decrease in economic growth over 2 successive quarters. The global financial crisis in 2007 is considered to be the most destructive financial crisis since the 1930s Great Depression. The global financial crisis was triggered by the increase in subprime lending in the housing market. This is when loans are given to people who have a high risk of defaulting. This created a housing bubble that eventually collapsed. The crisis was so severe because this caused large financial institutions such as Lehman Brothers, Fannie Mae, and Freddie Mac to collapse under bankruptcy, and the entire economy was in turmoil, particularly Thailand, South Korea, Malaysia, and Indonesia. The Asian crisis was triggered by the flotation of the Thai baht and significant decline in its value. This led to the collapse of the credit bubble as investors withdrew all their money from Asia. A chain of events suddenly spread throughout Asia, leaving Asian countries with devaluing currencies, high levels of foreign debt, and numerous bankruptcies. At the time, many of these Asian economies were emerging markets that were still dependent on foreign capital and investment for their growth. Hence, their path to recovery after the crisis was extremely difficult. Asian financial crisis of 1997 and the global financial crisis of 2008 are similar or different, focusing on the causes and consequences of each one.
The causes of the Asian financial crisis 1997-98. First, there was a lack of incentives for risk management as the financial institutions tended to lend recklessly without a prudent procedure of lending, as the institutions had expected a bailout provided by the Thai government or the Bank of Thailand if a bank run occurred. Next, we come to crony capitalism. Before the crisis erupted, firms with crony ties to banks and politicians in Thailand had greater access to long-term debt than firms without such ties, which is often referred to as crony capitalism. The same problem was also with the foreign creditors and depositors, as they credited money to the financial institutions with little care, having in mind the government's bailout policy. Development money went in a largely uncontrolled manner to certain people only, not particularly the best suited or most efficient, but those closest to the centers of power. After the mid-1990s, a series of external shocks such as the devaluation of the Chinese renminbi and the Japanese yen adversely affected export revenues and contributed to the slowing of the economic activity and declining asset prices. Also, the US economy began to recover from recession in the 1990s. The US raised the interest rates to head off inflation, thereby making it a more attractive investment destination, leading to a credit crunch in these South Asian countries. This raised the value of the US dollar, and this meant the fall in the exports of the Southeast Asian countries, as their exports became more expensive and less competitive in the global markets. The immediate cause of the crisis was speculative attacks by foreign investors in Thailand. The Thai baht, as a result, was allowed to float on July 2, 1997, and the exchange rate dropped by 15%. This led to panic among the investors, who quickly began to withdraw their investments, which further deepened the crisis and led to a wide spillover effects on other South Asian countries such as Indonesia, Malaysia, and South Korea.
Consequences of the Asian financial crisis 1997. We first talk about the effects of the crisis on the global economy. There were drastic depletions in values of currencies, stock markets, and other asset prices of several Asian countries like Indonesia, South Korea, and Thailand. People in millions fell under severe poverty as numerous businesses collapsed. The sudden distress also caused the price of oil to dramatically fall, which reached a low of $8 per barrel towards the end of 1998, causing a financial pinch in OPEC nations and other oil exporters. It led to economic stagnation in developing countries worldwide as foreign investors became unwilling to lend money to them. Now, we talk about the effects of political conditions globally. The crisis led to political turbulence, the peaks being in the resignation of Suharto in Indonesia and Chavalid Yongchayud in Thailand. The crisis in general was part of a global backlash against the Washington Consensus and institutions such as the IMF and World Bank, which became unpopular in developed countries, leading to the rise of the anti-globalization movement in 1999. Islamic and separatist movements boosted up in Indonesia as the central authority weakened. However, on a positive note, the crisis led to a renewed push for corporate governance in several countries, particularly in South Korea and Indonesia. Rampaging inflation weakened the authority of the Suharto regime and led to its downfall in 1998, accelerating East Timor's independence. As for the long-term consequences of the crisis, there was a turnabout of the relative profits made in the boom years just following the crisis. The CIA analysis suggests that between 1997 and 2005, the per capita income in Thailand declined from $8,800 to $8,300. In Malaysia, it declined from $11,100 to $10,400. In Indonesia, it declined from $4,600 to $3,700, despite a population increase of 30 million, suggesting an impact on that country similar to the Great Depression.
Now we come to the causes of the financial crisis 2007-2008. It all started with the easy availability of credit. In 2000, the Federal Reserve Chairman Alan Greenspan lowers the interest rate to only 1%, which causes the investors to not buy treasury bills, as 1% is a very low rate of interest. But on the other hand, banks could borrow from the Federal Reserve for only 1%. Added to this, there were foreign inflows from countries such as China, Japan, and Germany due to the savings glut caused due to the Asian financial crisis. So all of a sudden, there's an abundance of credit in the economy, causing the housing prices to rise rapidly. The second reason being the mortgage-backed securities. Lured by the returns of the mortgage-backed securities, government-sponsored enterprises such as Fannie Mae and Freddie Mac bought mortgages from the banks and pooled these resources into the MBS, guaranteeing them and selling them to investors known by a process called securitization. The demand for MBS was very high, as the MBS were rated very high by the rating agencies such as the Moody's and the Standard & Poor's. They also carried low risk and low return. Investors bought securities on the assumption that the US government would guarantee the insolvency of the GSEs. Due to the ratings, the demand for MBS kept increasing. Due to the investors investing a large amount of money in real estate purchases and low interest rates, the demand for housing increased, which drove the prices up. The prices of houses quickly outpaced salaries, thereby causing people to search new ways to finance home purchases. The rise of subprime lending. High demand caused house lenders to aggressively market to potential buyers, even with limited or no credit, which led to the rise of subprime lending. By 2000, most investment houses acquired subprime lenders. Subprime loan charged a higher rate of interest, however, requiring no down payment and limited documentation. But after a period of time, they could charge adjustable rate mortgage interest rates. Most companies were compensated on the volume of the loans rather than the quality of the loans. As subprime loans were on the rise, they peaked in the year 2006, causing the household debt to rise more than 100% of the annual US GDP. Interest rates began to rise and refinancing was more difficult now. The ARMs were now reset to higher interest rates, causing more of them to default on their payments, causing foreclosure and default activity to increase. In 2007, nearly 1.3 million housing properties were subject to foreclosure, up by 75% from 2006. the bubble bursts. This creates more supply than demand for houses, causing the prices of real estate housing to drop. The decline was felt by the investment banks and firms who own the mortgage-backed securities, because assets such as houses are supposed to be valued at the market price, and since the housing prices drop, the asset values drop, causing most of the firms to show negative net worth, which meant that their assets could no longer cover its liabilities, thereby becoming bankrupt. With asset values quickly deteriorating, banks were reluctant to lend to other institutions. This caused disaster, as firms relied on interbank market for finance. Almost most banks closed down, as most banks were either bankrupt or relied heavily on short-term borrowing because it had very little capital of its own. All these events brought the world economy to a standstill.
The United States was the epicenter of the crisis, and its economy was directly hit by the meltdown in the subprime mortgage market, along with the repercussions of the financial crisis and the ensuing credit crunch. As a consequence, the United States economy fell into a recession in December 2007 and is estimated to have shrunk by 2.7% in 2009. The impact of the crisis on developing countries has been far from universal. The most severely affected are the middle-income countries, especially the Central and Eastern Europe and the Commonwealth of Independent States. This has been driven by the combination of the credit crunch and domestic imbalances, such as the large current account deficits and the housing bubbles, the two being not unrelated. The countries estimated to contract by the greatest margin include Lithuania, Latvia, Armenia, Estonia, and Ukraine, which are expected to experience a decline in GDP of 14% or more in 2009. Due to its links with the United States, most of Latin America fell into a deep recession. A contraction of 2.1% has been estimated for 2009, though there is a considerate variation within the region. Mexico has been hit hardest and is expected to have contracted by 7.1% in 2009. In comparison, Brazil grew by 0.1%. Most low-income countries, however, evaded a recession, but the growth slowdown witnessed in these countries has nonetheless negative implications for poverty. Overall, the smaller, more open economies have been hit harder, while the larger, emerging economies have been supported by domestic demand and government spending. China and India have notably continued to grow strongly during the crisis. Moving from the variation in the contradiction of output to the impact on the labor market reveals that there is even more diversity in outcomes across countries. In OECD countries, the employment rate has increased from 5.7% to the third quarter of 2007 to 8.6% in the third quarter of 2009, representing a rise of 10.1 million individuals without jobs. The crisis has in general hit men harder in advanced economies, particularly younger men. Also, workers with lower levels of education have been more vulnerable to the impact of this crisis. This is again due to the over-presentations in sectors that have been badly affected, particularly construction.
The most common characteristics found in both crises are excessive leverage, excessive inflows of cash, and speculative attacks. In 1996 to 1997, excessive liquidity and cash inflows occurred as high interest rates in developing countries attracted many investors from developed countries, which led to a huge influx of foreign capital from developed countries. Due to the huge amount of liquidity, banks were flexible in lending and large amount of their assets were backed by real estate when the prices were rising. Since huge investment took place in real estate, the prices started to drop, highlighting the shaky position of the banks. The same happened during the 2008 financial crisis, where due to excess of liquidity, bad loans were made, due to which financial institutions suffered a lot. Due to the huge liquidity available, it also encouraged the rising of leverage. The great appeal of leverage is that when prices are going up, a modest gain on an investment can be turned into a huge gain. However, when prices are reducing, it can also magnify the loss, thereby wiping out the entire investment. So when a bank or firm is highly leveraged, a given percentage change in the value of its assets has a much larger proportional impact on its net worth. Given this extraordinary leverage, a minor aggregate shock can send a major bank or firm into insolvency.
Speculation was also a cause in both the crises, as speculation played a major role in both the financial crises. In Asian financial crisis, the devaluation of many Southeast Asian currencies caused speculation that it may devalue more, thereby most of the investors pulled funds out of the Asian economy. Also in the financial crisis 2008, there was a speculation and assumption that the real estate pricing houses would always rise. Financial or economic crises are a universal phenomenon and frequently recurring common events. East Asian countries were hit hard by the 1997 to 1998 financial crisis. A decade later, they suffered again from the global economic crisis. Since financial crises are common and repeating phenomena, we may not be able to completely avoid another round of crisis in the years to come. This is a great challenge facing the global economy, and the prevention of recurrence of future crises is urgently called for.